Today, we're going to look past the pure mechanics of consolidation accounting. We're going to explore its true purpose, which is really to tell the economic story of a company's strategic scope. You see, this isn't just about adding up numbers. It's about defining an empire.
So let's start with a really fundamental question. Where does a company actually begin and end? I mean, is it defined by its legal charters, its articles of incorporation, or is it something much more expansive, an economic entity, directed by a single controlling power? Well, consolidation accounting is the framework that tries to answer that very question.
All right, so to map this empire, first we have to define its borders. And in finance, these borders are not drawn by legal filings, they're drawn by a single, incredibly powerful concept: control. It's the principle that determines the economic entity before any accounting could even begin.
Now, control is more nuanced than you might think. It's not just a simple 50% ownership test. It's really a two-part assessment. First, an entity has to have the power to direct the key activities that drive returns. And second, it must have exposure to the variable returns that come from those activities. This combination, this 1-2 punch of power and economic stake, is the absolute cornerstone of consolidation. It's also why standards have evolved to capture really complex structures, like variable interest entities, where control can exist even without majority ownership.
So you can think of it this way. Consolidation is the language we use to translate the economic reality of control into a financial report. The consolidated statements become a map of the entire economic empire, presenting every single asset and liability under the parent's effective command as one cohesive unit.
This brings us to a critical pivot point. Okay, so once we've established that control exists and we've defined the empire's boundaries, the next logical question for any manager or investor has to be, what is that control actually worth? How do we put a price on it at the very moment it's acquired? We answer that question with what's called the acquisition method. And let's be clear, this is not just some mechanical check-the-box process. It's a rigorous valuation exercise designed to determine the fair price of control on one specific day, and that's the acquisition date.
The real heart of this method, where all the action is step 3, measuring all of the acquired company's identifiable assets and liabilities at fair value. This is the moment we basically wipe the slate clean of all the historical costs and reevaluate the entire entity based on its true economic worth at that exact moment of acquisition.
Now, any amount paid over and above that fair value becomes goodwill. But what is goodwill really? It's not some accounting abstraction. It's the price you paid for future value, for the expected synergies, the amazing talent, or the market position that justified the deal in the first place. For a savvy analyst, a big goodwill balance is a signal to really scrutinize management's acquisition strategy, because those subsequent impairment tests become a recurring report card on that initial bet.
Of course, control is rarely absolute. I mean, an acquirer might gain control with, say, 80% ownership, not 100. This introduces another fascinating layer to our economic story: the other owners who have a stake in a piece of the empire, but really have no say in its overall direction.
So, while the parent company controls 100% of the subsidiary and consolidates all of its assets and liabilities, it might only have an economic claim to 80% of its net assets. That remaining 20% is a very real claim held by other owners, and we call that the non-controlling interest, or NCI.
This illustrates a really key asymmetry. The parent has full control over the group's strategy and resources. The NCI, on the other hand, has zero control, but it retains a direct claim on the net assets of its specific subsidiary. And that distinction is absolutely critical for understanding risk, cash flow rights, and all the different incentives within the consolidated group.
Okay, so we've mapped the empire and we've accounted for all of its owners. The final step in presenting a coherent picture is to measure its true performance with the outside world. And to do that, we have to strip away all the noise of internal transactions.
Here's the core problem we're trying to solve. If a subsidiary sells goods to its parent, has the consolidated group as a whole actually earned any revenue? The answer is no. It's just moving money from one pocket to another. Reporting this as an external sale would fundamentally misrepresent the group's true economic performance.
For instance, let's say a subsidiary books a $100 sale to its parent. Without any adjustment, that $100 flows directly into the consolidated revenue line. But since no cash has actually entered the empire from an external customer, the group's performance looks artificially inflated.
The solution is what we call an elimination entry. We simply remove the $100 intercompany sale and any related profit. What's left on the consolidated income statement is revenue that comes only from sales to third-party customers, giving us a truthful measure of the empire's economic interaction with the rest of the world.
Okay, so let's bring all of these pieces together. We've defined control, we've valued it at acquisition, we've accounted for non-controlling partners, and we've eliminated the internal transactions. So why? Why does this meticulously constructed picture actually matter for making capital allocation decisions?
It matters because the consolidated statement is an absolutely indispensable analytical tool. It gives you a holistic view of management strategy and the business's true economic footprint. It lets us track synergy realization against the goodwill that was paid. It provides a complete picture of group-wide risks, and it forms a really robust foundation for analyzing long-term value creation.
I think this quote just captures the essence of it perfectly. These reports are so much more than compliance documents. They are a narrative, a report card on management's execution of its empire-building strategy.
And that leaves us with a final, orienting thought. You see, consolidation gives us the map of the empire. It tells us what the firm controls. But for a sharp analyst, the real work begins right there. The deeper question, the one that truly drives valuation, is using that map to understand how well they control it.